Hello and welcome. My name is Benoit Poliquin, and I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching our first quarter of 2023 market review. Really, it should be called an extension of the previous quarterly review where we really looked at the unintended consequences of the past few years from an economics perspective. So we're going to be looking at what had transpired in the markets in the past quarter, and we're going to look forward to a few events that we're expecting to impact investors. As always, you can hit the pause button or the fast forward button if you want to slow down or speed up the presentation. Thank you for watching. This has got to be the most anticipated recession that I'm aware of. While we did have an economic slowdown last summer, which would have qualified as a recession, had it not been for the strong employment data. Now, this quarter saw a rebound in prices in both stocks and bonds. Now, the question is it a dead cat bounce or a new bull market? So we're going to look at both sides of that question. Now, we had bank failures grab the headlines for about a week, and since then, we really haven't heard much about them. Wages, employment numbers, that's all been and continues to be a larger part of the markets in terms of what markets are worried about. Interest rates receded and wages continue to hold up. And now these wages and these employment rates, which are as hot as ever, really bode well for consumer spending for the next quarter. As always, we're going to look at our summary table. So what we've got in terms of a summary table is, if we start at the top, we've got the S&P TSX, the Canadian market. It ended at 19, just shy of 20,000. And that translates into a positive 4.6% number for the quarter. We're still looking at a negative number on a 12-month basis, however. The S&P 500 had a very strong quarter, up 7%, and still basically flat for the year, or a rolling 12 months. The NASDAQ had a really rough 2022, and we're still negative on the 12-month numbers, despite having a very strong first quarter of 2023. The surprise here that no one's really talking about is the European stocks really have been doing very well for the past 12 months and are up 9% this quarter. Oil prices were down. I mean, they're up $5 in the first quarter or in the first day of April, but we're still down despite the $5 jump since the end of March. We're still, in negative territory over the past 12 months. Gold prices, they're up. Another silent winner that not a lot of people are talking about, up 16 or 1.6% for the year, but up 8% for the quarter. Interest rates, as I've said, have receded. Now, on a one-year basis, you will loan the government of Canada money and receive 4.6%. And over the 5-year term, it would be around 3.4%. And if you want to go out 10 years, it's 3.3%. So really, it's an anomaly because usually as you go out in time, you tend to earn more money as a lender to the government of Canada. And this is what we call an inverted yield curve, meaning short-term rates are higher than the longer-term rates. On the GIC market, one-year numbers, we're down from the 5% we saw at the end of last quarter, but we're still up at the 4.8 on a one-year basis. And if you go out 5 years, you're getting about 4.3%. If you remember last quarter's presentation, I said that 2022 was marked by the previous bull market winners really having a tough time. I called them the generals, and they were dead. Now they're back. There's a great article in the Wall Street Journal, which let me highlight it for you here. So last quarter was dominated, or the 2022 fourth quarter presentation. I talked about the generals or the leaders of the last bull market kind of dying. And now the theme of the first quarter is the generals are back. So there's a great article in Wall Street Journal that appeared maybe a few days ago, in late March, where it talked about the very focused performance of the S&P 500. In fact, stock pickers, people like us that choose stocks as opposed to indexers, really had a tough time to keep up with the performance this past quarter. So here's what I mean mathematically. The S&P 500 was up 269 points, 7% in US dollar terms. And the top 10 stocks moved up 222 points, meaning 83% of the performance of the S&P 500 can be explained by those 10 stocks. Now, most portfolio managers will have anywhere between 25 all the way up to 200 stocks. So the more stocks you own, the more difficult it is to replicate, because the S&P 500, both the performance and the market weight or market value is really focused in these top 10 stocks. So if you're looking at your portfolio and it hasn't kept up with the indices, it's basically the explanation. In Canada, we had a very similar situation where the technology sector of the index, which is called the info technology, which is really Shopify and a few other technology names, and I'll show you in a minute what those are, really were up 20%, while energy and financials and also healthcare, but the big pillars of the S&P 500 or the Canadian S&P TSX index are really energy and financials, which had a negative return. So if we look at the top performer names, we're looking at, of course, Shopify, Constellation, Couche-Tard. So a lot of these names really had positive returns, and you're seeing a lot of tech names. Now, remember, these tech names are very sensitive to interest rates. As interest rates move down, the valuation of these growth stocks tend to increase dramatically. Now, I've mentioned this before, but investors are really dealing with a three-headed monster. You're looking at interest rates, the economic growth or recession, as I said, the most awaited recession in a long time, and the labor markets. Now, in the previous quarter, last quarter, we covered that high interest rates lowered the value of future cash flows. And you can see it here. So we're going to put up a link here for you if you want to look at last quarter's quarterly review. So we know that higher interest rates lowers the value of future cash flows. So as interest rates go up, the value of all assets come down. But banks have also had to deal with higher interest rates, and that's what we're going to talk about in the next few slides. Investors like banks, insurance companies, and pension funds are all mandated to invest in bonds. Now we know that as interest rates rise, bond prices fall as well. Now, because bonds are considered much safer than equities, that's why quote-unquote safe investors like bank, insurance companies, and pension funds are mandated to invest in such a heavy degree in the bond market. Now, it's true that the bonds are much safer than equities, except in a rising rate environment. So we're going to look at the balance sheet and what that means. So we'll make it very simple for you to understand, but it's an important concept for all investors to wrap their heads around. So it's much more than the flesh wound, these rise in interest rates. So this interest rate rise is really getting quite serious. So you're looking here at how quickly the U.S. Fed has moved in historical context. So 2022, so far in terms of this interest rate cycle, has both been the shortest in terms of how quickly interest rates have moved and how dramatic or the amplitude of the move. So it's really, really important. In the past 40 years, we've never seen rates move this quickly and this dramatically for investors. So the speed is also important, how quickly this happened. Now remember, bonds are the largest share of portfolios for, or the largest component of portfolios for banks, insurance companies, and pension funds. So why does that matter? So if we look at, this is an ETF, so it tracks the prices of a portfolio or a basket of 7 to 10 year US government bonds. Now it peaked in terms of its value back in, let's call it November, October, November of 2020, just 2020, just when interest rates were at their lowest. And since then, it's been on a steadily march downwards in terms of value. Now, why is that? Well, it's quite normal when you stop and think about it. As we've been saying for many presentations now, as bond interest rates rise, the prices of bonds follows the opposite direction. So in this case, this move down for this portfolio is down 20%. So if you're a bank, an insurance company, or a pension fund, your bond portfolio is down likely around these areas of 20%, depending, maybe a little less, maybe a little bit more, depending on what happened. Now, remember, so the latest sort of bank craze or bank run or bank crisis, whatever you want to call it, is really not necessarily that the banks did anything wrong. It's more that it's an unintended consequence of a sudden rise in interest rates. So let's see what we mean. So as an investor, if I would get one superpower, would be to be able to go back in time. So if we had this ability to go back in time, and we could look at headlines. So here's a headline from June of 2021. So I have 4 headlines for you, but to just give you an example of what the consensus with the headlines, where were investors thinking about. So here's a headline from June, the summer of 2021. U.S. officials signal they expect to raise rates by the end of 2023, so the end of this current year. Now, the previous slide, I showed you how quickly rates moved and how far they went. So this goes against what we've experienced in the past year or so, completely goes against what we were expecting as investors, or what the consensus was expecting 2 years ago. If we're looking at another headline, here's one of the other Fed governors saying they really don't see an end to central banks actually stopping to buy bonds. So if you remember back in 2020 and 2021, central banks not only had rates basically at zero, they were also actively involved in buying up the bond market in order to keep interest rates very low. And so here's one Fed official saying he doesn't expect to slow this bond purchase. Another Fed official expects near zero interest rates well into 22, probably 2023. So the point here is, in the summer of 2021, no one was expecting any sort of rise in interest rates. It was being pushed out well into the future. And the expectation was, if you remember, this is another interest one, early in 2021, where politicians were still talking about a relief plan and sending money directly to citizens and boosting unemployment insurance and so on and so forth. So it was very inflationary in terms of what we're trying to do. And so as a bank, if you were getting all these deposits coming into your bank, you had to make a decision to make where to invest it. Now, if bankers were expecting rates to be on the rise and rise quickly and rise in short order, obviously they could have mitigated the potential losses by investing in, say, short-term interest rates or just being prepared for it. But on the other hand, if there's central bankers and just pundits are telling everyone that rates will not rise for the foreseeable future, you can't really blame bankers to invest to maximize returns and thus buying long-term maturities. So that's really what's going on right now for investors. So I'm going to talk a little bit in plain English, and for all you accountants out there, it's an oversimplified model. And for those of you that don't like accounting or finance, this is just a simplified way of what a bank run looks like. And you might have read headlines and sort of wondered whether or not it's something to worry about. Now, bank runs happen in the U.S. Not often. So typically, they're over. If we look at the number of banks in the U.S., there's 4,200 banks that are insured and regulated by the regulators. And in a typical year, say since 2015, anywhere between 0 and 8 banks have failed. So the regulators step in and they look at, and they take over the operations and look to redistribute the assets, if you will, to the rest of the industry. In 2010, as an example, there were over 6,000 banks. So this is at the at the dusk of the financial crisis, just coming out of the financial crisis, 157 banks failed, and there were at the time 6,000 banks in the U.S. So there's been a lot of consolidation since 2010 in the past 12 years, but the bank failure is still quite small. But it's still important to understand why it matters. So let's just say a few quarters ago I talked about inflation, and I used the example of a lemonade stand. So here, let's just say you want to get out of the lemonade stand business, and you decide that the real money is in banking to the lemonade stand business. So let's just say you take your capital and you do $5,000 and you start up a bank. So you need investment capital, and then you go out and look for deposits. Now, deposits for a bank are actually debt. Someone deposits money with their bank, but they can always come back and ask for it. So you need to pay interest to your depositors. You then take this $25,000 of capital, and then as a bank, you invest it. So you might invest it in cash. You might leave it, with other banks and earn a bit of interest. You'll also obviously you're in the lemonade stand business. That's your niche. So you might extend loans to lemonade stands, and that's your portfolio of loans. So let's just say half or $10,000 out of your $25,000 of capital, you will invest in lemonade stands and build a portfolio of loans on that. And then you might buy government bonds. And again, central bankers told you the rates aren't going anywhere. They're going to stay low for longer. And so you decide to extend your maturities and you buy 7 to 10 year bonds, and they're safe. I mean, at the end of the day, governments always pay their creditors back. But let's just say that central bankers and pundits were wrong. And you fast forward a year and your bonds weren't worth $10,000, but they're now down 20%. So they're worth $8,000. The next logical step is to value your loan book. So those loans that you extended are probably down 20% as well because interest rates have risen. The loan book might still be okay and everyone's making their interest payments and their principal payments, but the value of that bond still might be down 20%. So your total assets have moved down $4,000. Your deposit, let's just say your deposit hasn't changed. So you didn't get any more deposits or any less. But your investment capital is down. That's where the losses hit. So basically the investors are now they used to have $5,000. Now they have $1,000. So they have a significant loss where they lost 80% of their capital. So when you're hearing or reading headlines about a massive hit on capital, that's really where that's what it means. So your regulators might come in and say, you know what, Lemonade Bank, we want you to raise more equity. So we want you to go out and find more investors because we want you to quote unquote shore up your capital here. Okay, that's fine. That can be done. But the problem is if your depositors get wind of this and kind of start hearing rumors, and maybe your rumors are spread by your competitors, or maybe someone tried to buy you last year and you couldn't do a deal, so they might be more inclined to lower your value and sort of make life hard for you. So your depositors start to get worried, and so they decide to pull their deposits. Well, that can happen very, very quickly. So at that point, not only do you have a capital problem, but all of a sudden you have to start selling your portfolio at a loss in order to make good on those deposits. And that's what a bank run is all about. So regulators are there to obviously regulate, and it happens very, very quickly, and to try to shore up the capital. If that can't be done, they will orchestrate a buyout or a merger, not a merger, but just a clean buyout where the assets will be taken over by another competitor. So that's what, in essence, is a bank run. So the interesting thing about a bank run is no one's worried about banks until everyone is, and they're all worried at once. So technology, think about the ability to move large sums of money just off your phone. So technology, niche markets, if you're just dealing with the lemonade business and that goes sour on you, you've got significant issues. Maybe you've got niche markets geographically and you're dependent on that geographic area is dependent on one or two sectors of the economy, and if those sectors have a tough time, obviously the bank is going to have a tough time. So Silicon Valley Bank. We know that the tech sector in 2022 had really, really difficult times, and so it follows that the bank serving that sector would also have a difficult time. Illiquid and arcane investments or portfolios really come and exacerbate this problem. This makes it worse. Now, I've been showing you this slide for past few quarters now. When you're reading headlines, there's a lot of risks and sort of, we know that if that newsmakers tend to not only focus on the dangers, if you will. So I like to show this slide to really sort of flip the risk into opportunities. So there's a demographic challenge that we know. The demographic in the Western world is getting older. There's a shift in what most people want in terms of the source of energy. Regulations are getting more strict, more difficult, more onerous, and there's always the threat of inflation. So these are all sort of prevailing winds, if you will, but we like to look them as opportunities. So one of the ways to get exposure to profit from these is, if you think about demographic trends, things like technology can turn the problem, or if technology will solve this problem and then it becomes very profitable to those that offer it. Pharmaceuticals, medical devices, energy productions, all sorts of energy services and infrastructure, utilities, financials, and brands and pricing power. These are all things that we look at in terms of when we're looking for new investment ideas or just monitoring your existing investments. Those are the themes that we're really looking at to make sure that we're well positioned for these prevailing winds that are right now are the subject of investment markets, if you will. So let's look at the next few quarters and what are we looking at? What are we worried about? So we'll start with the bearish case for the next few quarters. I mean, it's pretty obvious. You've got continued rise in rates. You've got a banking sector. We had 3 bank failures in the last quarter. Well, more to come. Commercial real estate has been an issue as well. I mean, all of these, these top 3, these banking sector and commercial real estate issues are really a function of this continued rise in interest rates. The commercial real estate issue is starting to come up again. I mean, you stop and think about it. The commercial real estate sector is really getting hit from all sides. So if you stop and think about it, the sector is subject to higher interest rates by way of the mortgages. As these mortgages are going to come due, the mortgages that are the rates at which they'll be renewing on the properties will be higher. So they'll pay more in terms of interest costs. And B, the valuation of future rents will be lower because interest rates are higher. And moreover, those rents are actually in question. I mean, with work from home and or a slowing economy, the next logical conclusion is that the need for space will diminish. So commercial real estate is a bit of an issue, much broader than, say, the banking sector for many investors and pundits, because banks, pension funds, and insurance companies, not only do they own a lot of real estate, if they don't own the properties, they're also large players in buying the debt or the mortgage on those real estates. And so that sector, although may not look on the face of it as that important to the economy, it's very important to the investments of all of us, really, when it comes to pension funds, insurance companies, and banks. So the commercial real estate is certainly a concern, and you're going to probably hear more and more about this issue. Geopolitical tensions, well, really, I've been making these presentations for 20 years now, and you can always put it up. There's always something wrong politically. There's always a tension, proxy wars, you name it. There's always something going on. And government spending and debts, that's also another problem for investors that doesn't seem to go away. But let's look at the bullish case for a minute. So we're seeing fund flow. So even in a recession, there's always capital looking for opportunities, even in a bear market or a recession. The second point is the negative news already baked in. Now, if everyone's waiting for the bus and the bus doesn't come in, it's a problem. But if no one's expecting the bus to come, then and if it doesn't show up, then it's not really an issue. So what do I mean by that? Well, a lot of stocks are reflecting a lot of future bad news already in their current quotes. So it doesn't take much in terms of better than expected or even less than bad or less bad than expected in terms of the news flow for these prices to increase. Technological advances. Now, I wanted to mention that because it's really, really important. I mean, if you go back 20 years, you've had these massive changes. You have more power, more computing power on our phone than we used to have on our desktop. You can work from anywhere in the world, literally off this phone. The internet, all of these things have been a bonanza for the world and really for in companies that have been able to harness the new technology. So it's rarely, or not always, I should say, the people or the companies that come out with this new technology, but it's always those that harness the new technology that tend to do well. So I wanted to mention things like ChatGPT, but I wanted to keep this video short enough. So but all of these, even new technologies are very often presented as a negative aspect where people will lose their jobs or just all sorts of things. We prefer to look at it as a new tool or new lever, and we want to look for the companies that are adopting and leveraging this new technology. Now, in terms of a slowing down economy, whether we're in a real recession or just this slow grind of an economy, we like to use the barbell approach, which is you're looking for companies and sectors that do well when the economy slows down. So think of off-priced discounters or retailers. And then on the high end, so if luxury brands or luxury travel or luxury cars, where that strata of the economy is not really that affected by a slowing economy. So we call that the barbell approach. And then quality always wins. At the end of the day, this is not the last nor the first economic slowdown or anemic growth period. So good companies, quality companies, they rarely make the news, but they tend to do well. They prepare the next leg up so they can buy competitors, build their brands through advertising at the expense of weaker players. And also, in this war for talent, they can attract top talent during difficult times. So there's always a bullish case and a bearish case in every investment decision. Lastly, I want to talk about psychological biases. I'm seeing as that we're meeting with clients and things, the past 3 years have been, I don't want to say traumatic, but very difficult for many. And that's entirely normal. And so I came across this article a while back, and I sort of kept it, and you can Google it right here. And so investors are humans too, and so we're kind of wired a certain way. And when the investment landscape is fluid or things get tense, we tend to gravitate towards some ingrained habits. So just like zebras run just because the zebras around them are running, we tend to react out of instinct in difficult situations. So I have a lot. I've mentioned this article goes through a number of biases, and I've kept probably too many. I just want to go through a few of them, and later we can pause the video. But the representative bias, basically people jump to conclusions. That's entirely true based on what our most recent or earlier experiences has been. Cognitive dissonance. So when we face new information, we fail to change with it. Very often we will kind of ignore information or facts that contradict our convictions. As investors, that is deadly. So home country, well, yeah, but here at Exponent, we cover Canadian stocks, U.S. stocks, and global dividend-paying stocks, the large global brands that are not domiciled in North America, but certainly could be. So you really want to look at as the world and the global growth, if you will, is not happening in Western world. It's happening in the developing world. So you have to understand and look for ways to get away from this home country or familiarity bias. So again, confirmation bias, we don't want to hear information that contradicts our beliefs. Our Our moods, this is an important one. Our moods, our optimism or pessimism. If we're a natural optimistic people, we'll tend to, very often they will buy or look for the latest and greatest in their investment portfolio. You may want to temper that down a little bit. And also others will tend to be, especially as we move on in time and the assets get larger, we tend to be a little bit more pessimistic in terms of the outlook. And that's entirely normal. And we just have to recognize that bias. So the stats quo, naturally, we hate change. So whether it's in the portfolios or whether it's in the approach and so on. So as an investor, you have to understand that bias. The small numbers. So very, very often we call it, here in the office, we call it anecdotal evidence. So it doesn't mean that you went to a store or you traveled to a country or just tried this new product that it necessarily makes the company making this new product is necessarily a good investment. It may be new to you, but it may have been, old in the market or been around in the market. So this is an important one, and I'm really, this is guilty of this one personally. I'm guilty of that. I tend to sell the winners much too soon. We've adopted that, some safeguards, and also hanging on to the losers a little too much. So personally, I will certainly own this bias. Certainly, probably all of them, but this one is certainly one I'm well aware of that I in times of stress, I tend to fall into the bad habits of that. Just going to go through a few more. The change in risk parameters. So that one's interesting. So our most recent positive or negative experience in terms of investing will drive our decisions. So basically it's called the gambler's fatal flaw. So you might start small, you start making some outcomes, and as you become more successful, you're willing to take on greater risks. And the opposite is true, which means, if you've had negative outcomes more recently, you're then more slower to turn into markets. What does that really mean in plain English? That's the bias that gets us to sell low and buy high. So we buy late, we buy high, and then we sell low. And then finally, media biases and the internet. I proved that a few slides ago. The consensus is rarely right. So reading the news, others' opinions is really not acquiring knowledge. It's just the acquisition of information. But investment research is much more than information. It's about knowledge and how to use this information and whether or not you can ascertain, critical think through it, whether or not it's a good idea or not. So these are all some of the biases. If you Google this article, there's many more. It's fascinating stuff. As always, thank you so much for watching. We value your business and we value your comments. So don't hesitate to send us an email if there's any questions or comments about the presentations or anything else investment related. Thank you very much. I'm Benoit Poliquin for Exponent Investment Management.